Reliance currently trades at a blended enterprise multiple of 13.5 times EBITDA, a valuation setting it apart from every other industrial conglomerate of this scale. Traditional petrochemical giants typically face a double-digit multiple ceiling. Their valuations are often suppressed by the inherent volatility of global refining margins and commodity cycles. Despite these legacy constraints, MK Global's CY26 update projects Reliance's total enterprise value will climb past 24 trillion rupees by financial year 2027. This valuation is built on a specific structural pivot. Reliance is systematically moving its primary cash generation away from old-world refining and into high-growth technology and consumer ecosystems. To understand if the company can actually support this premium, institutional investors must deconstruct the aggregate valuation and evaluate the specific execution risks tied to each new vertical. Exhibit 1 details how the 24 trillion rupee enterprise value is assembled. Multiples vary. Oil to chemicals is 8 times, telecom 12 times, and organized retail hits 27 times. Adjusted for debt, the total equity value of 22.7 trillion rupees supports a 1,680 rupee target price. Sustaining a 27 times multiple in retail and a 12 times multiple in telecom requires Reliance to achieve a level of operational efficiency that exceeds typical industry standards, placing the entire valuation on the success of these higher-risk models. Ultimately, this valuation represents a massive bet on the company's ability to successfully integrate these frontier industries into a single, cohesive entity. The foundation of this entire expansion remains the oil-to-chemical segment, which provides the consistent cash flow needed to fund the company's multi-sector capital requirements. This chart shows that at an 8 times multiple, the O2C division contributes over 5.1 trillion rupees to the total enterprise value, making it the second-largest piece of the SOTP model. Reliance is insulating this segment from energy transition risks by actively shifting its refinery output away from transportation fuels. Refined hydrocarbons are being redirected into high-value materials. This includes the 3 million metric ton PTA project at Dahej and the Hazira carbon fiber facility, which will be among the largest in the world. The 1.2 million metric ton PVC project at Nagothane further deepens this shift, targeting domestic infrastructure demand and reducing dependence on imports. Transforming the O2C business into an advanced materials platform ensures the cash flow remains resilient enough to fund the more aggressively priced technology and consumer segments. This cash flow supports the telecom and geo vertical, which accounts for 7.56 trillion rupees of the total enterprise value. With the board's approval of the Geo Platforms IPO, the company is preparing a fresh issue of up to 270 million shares, implying a standalone valuation of roughly 12.5 trillion rupees. To justify a 12 times multiple, Geo is moving vertically beyond pure telecom services and into sovereign AI infrastructure. The Jamnagar hardware layer adds 120 megawatts of compute via NVIDIA GPUs. Above it, the software layer leverages a Meta partnership for open-source Llama hosting. Finally, the application layer integrates these AI features across Geo Home, 5G enterprise slicing, and streaming apps. This vertical ownership allows Geo to transition its revenue model from standard data co-location to high-margin dedicated GPU as a service. Controlling everything from the compute capacity to the final consumer application is the strategy Reliance is using to defend its 12 times telecom multiple. The highest valuation premium in the model is the 27 times multiple assigned to organized retail. Much of this premium is tied to Reliance Consumer Products, which aims to quadruple its revenue to 1 trillion rupees by financial year 2030. Supporting this massive target is a 300 billion rupee investment to build an AI-driven, robotics-enabled food manufacturing network. The company has already built a distribution network of 3 million outlets through 5,000 distributors, with plans to expand aggressively into under-penetrated markets like Bihar and the Northeast. The strategy relies on full backward integration, owning the cold chain logistics from the farm source to the final point of delivery. This manufacturing and distribution network is integrated with GeoMart's quick commerce platform, which now covers over 5,100 PIN codes. This 27 times multiple is based on the retail arm functioning as a technology-led FMCG logistics platform, rather than a traditional network of physical storefronts. The final row of the SOTP model is new energy, which is currently valued at 2 times invested capital. This segment has moved beyond its initial investment phase and is now entering active commercialization, with solar module revenues expected to begin in financial year 2026. The physical infrastructure is centered on 550,000 acres in Kutch, where Reliance is developing a massive renewable energy hub. The architecture integrates 55 megawatts of solar capacity installed daily, with 120 gigawatt-hours of battery storage, feeding directly into the Jamnagar electrolyzer gigafactory. This allows Reliance to monetize green hydrogen through high-demand derivatives, including green ammonia and biomethanol for transport and industrial use. To reduce demand uncertainty, the company has already secured significant offtake agreements, including a $3 billion green ammonia supply deal with Samsung C&T. This pre-sold model positions new energy to become a significant earnings driver as the facilities come online. The validity of the 24 trillion rupee valuation depends on the company's transition from heavy capital deployment to consistent cash generation. These projections track Reliance's consolidated cash flows through 2029, illustrating the relationship between its investments and its earnings. In financial year 2027, the heavy capital expenditure for major gigafactories begins to taper, falling as operating cash flows continue to climb. This shift is expected to double the consolidated EBITDA as the new energy and AI verticals begin contributing commercial revenue at scale. Reaching this inflection point validates the company's strategy of front-loading massive capital investments to secure a dominant position in emerging markets. For institutional investors, the definitive metric for this transition is the free cash flow to firm yield. This yield is projected to grow from 2.2% in financial year 2025 to 7.1% by 2029. The 24 trillion rupee SOTP valuation is essentially a tally of individual strategic bets that rely on the same corporate playbook. The success of this playbook depends on flawless vertical integration across the energy, technology, and consumer sectors at an unprecedented scale. Ultimately, these figures represent a transition into a high-yield entity that controls the critical energy and technology infrastructure of the domestic market.